Yes, so today I want us to look on this new topic, and basically the topic is on accounting for leases. So as far as this topic is concerned, one, we are going to define what is a lease. Then from there, we are going to look on the different types of leases, or basically the various ways in terms of how leases are classified by this particular standard here, because we have three categories of leases in accordance with IFRS 16 for accounting purpose. And then from there, we're going to look on how the leases are accounted for by two parties in a lease. We're going to see that we have two parties in a lease, and also we're going to look on how do those two parties in this particular lease account for the lease. But we're going to start by defining what is a lease. Generally, a lease is a form of a contract whereby the owner of the asset basically gives another party the right to use that asset for a specific period of time, and the person who has been given the right to use the asset is expected to pay some periodical payment. For example, if I own an asset, I can give you something called the right of use. The right of use. So basically, it means that I've given you the right to use that asset for a specific period of time, maybe 2 years, 3 years, or 5 years, and then at the start of each year, or maybe at the end of each year, you'll be paying me a certain amount of money as a result of using an asset which I own. And therefore, in this particular contract here, we have two parties. We have the owner of the asset, and basically the owner of the asset, this one is called the lessor. Is called the lessor. If I'm the owner of the asset, I'm known as the lessor. In this case, I will give you the right to use the asset. I will give you the right to use the asset. And basically, in that case, you are known as the lessee. You are known as the lessee. The lessee is the person who has been given the right of use. The right of use. And actually, now we are saying the lessor is the owner of the asset. So therefore, it is important for you to know that in this contract, basically, there are two parties. We have the owner of the asset, who is called the lessor, and this is the person who gives the right of use to another person who is called the lessee. And actually, we are saying the lessee is automatically expected to pay some periodical payment as a result of using an asset which belongs to another person. Now, how are the leases accounted for? Leases are accounted for by these two parties in accordance with this particular standard here, IFRS 16. It is also important for me to mention that IFRS 16, basically this is a new standard, is a new IFRS, which was issued by a body which is called International Accounting Standard Board to replace the old standard on leases, that is IAS 17. Previously, leases were accounted for in accordance with the International Accounting Standard number 17, but we are saying that this particular standard has been scrapped. It has been done away with and replaced by a new standard, which is IFRS 16. Currently, these two parties, the owner of the asset and the lessee, should account for the leases in accordance with what? In accordance with IFRS 16. Now, before we look on how the leases are accounted for by the owner and basically this other party, we can first of all look on the different types of leases. Basically, the way in terms of how leases are classified by this particular standard, types of leases. Now, for accounting purpose, leases are classified into three main categories. One, we have the finance lease. In some books basically refer to this as a capital lease, but the key term used by the standard is the finance lease. Number two, we have an operating lease. And number three, we have something called a short-term lease. So what do you mean by the finance or a capital lease? We say that this is a type of a lease. Which transfers is basically a lease which transfers the rewards, and also the risks. It transfers the rewards and risk associated with the assets, to the lessee. This is a type of the lease, which will transfer the rewards or basically the benefits associated with the asset and the risks associated with the asset to this particular person here. So basically what that means is that under the finance or basically the capital risk, once, for example, I lease an asset to you, I will transfer all the rewards and all the risks associated with that particular asset to you. So it basically means that as a result of having leased that asset, number one, you have the responsibility basically to repair that building. So in case something happened to that building, assuming it is like a, in case something happened to that particular asset, assuming it's a building, you have the responsibility to do what? To repair that particular building, because all the risks associated with that particular buildings, that asset have been transferred to you. Also, you have the responsibility to ensure that particular to ensure that particular asset or to ensure that particular building. So mostly these particular finance or capital risks are usually the long-term risk, or a type of a risk whereby you can lease an entire asset. Like maybe you lease an entire building for 2 years. It basically means that all the benefits associated with that particular asset, all the risks associated with that particular asset have been transferred to you as who? As the lessee. So that's why we are saying the finance risk or a capital risk basically is that particular risk which transfers all the rewards, all the risks which are associated with the asset to the person who is called the lessee. Now, on the other hand, when we talk about an operating risk, we say that this is any other risk, any other risk other than finance what? Other than finance risk. In other terms, this is the risk which do not transfer the rewards and risks associated with the asset to the lessee. Usually these are those particular risks whereby you may be owning an asset like a building, but you have leased that building to a number of tenants. It basically means that being the owner of the asset, you are deriving the economic benefit because you are the person who is collecting the rent. Number two, all the risks associated with the buildings remains with you. Despite having leased out that building, you have the responsibility to carry out maintenance work. As far as the building is concerned, you also have the responsibility to ensure the building is insured. You have not transferred the risk and rewards associated with that particular asset to the lessee, despite having leased out that particular asset. So that is an operating risk. Then from there, we have the other type of risk, and that is the short-term risk. And basically, we say that this is a risk, whose risk term is 1 year or less. 1 year or less. 1 year or less. So basically, it is a type of a risk whose risk term is 1 year or less. So in this case, when we talk about the risk term, basically you're referring to that particular period of time the asset is leased or the asset is leased out. So if, for example, in this case, I own an asset and basically I do what? I give you the right to use that asset for a period of 1 year or less, maybe 3 months, 6 months, basically a period which is not more than 1 year. That automatically is a short-term is a short-term risk. So therefore, for accounting purpose, this particular standard IFRS 16 basically classifies the risks into those three categories: finance risk, operating risk, and the short-term risks. Now, having that classification, I want us to proceed and basically look on how the risks are accounted for. And we're going to start by looking on how the risks are accounted for by the lessee. Remember, in this case, we have said the lessee is the person who has been given the right to use the asset. If I own the asset, I give you the right, or we enter into a contract whereby I will give you the right to use that asset, maybe for the next 2 years, for the next 3 years. I'm the owner, or basically the lessor, you are the lessee. So therefore, I want us to look on how the risks are accounted for by this person here, accounting for risks. Accounting for risks by the lessee. Now, the first point here, maybe I need to mention is that the lessee, basically who is the person who has been given the right to use the asset, One, this person is prohibited by the new standard here from classifying the risk as operating or finance. So meaning that having risk an asset, whenever you are accounting for that risk, you are prohibited by this standard from classifying the risk as what? As a finance or operating. As a finance or what? Or operating. Maybe that is the first thing we can be able to note down here. We can be able to note down, and we say that IFRS 16 prohibits RECI from classifying the risk as operating or finance. As operating or what? Or finance. What does that mean? It basically means that the classification of the risk as operating or basically finance risk, that only happens to the owner of the asset. The owner of the asset is the one who is permitted by this standard to classify the risk as operating or finance. But we are saying, as the person who has been given the right to use the asset, you are totally prohibited by this standard from classifying the risk as operating or finance. Whenever you're accounting for this risk, don't classify the risk as operating or what? Or finance. And therefore, this standard requires that at the inception date of the risk. So when we talk about the inception date, basically we are talking of the date when the risk commenced. So at the inception date, this particular person here is required to recognize, to compute, and recognize two items in his books of account. So meaning that at the inception date, and in this case, I've said the inception date is the date when the risk commenced. The date when the risk commenced. So this person is required to recognize two items. One, something called the right of use asset. The right of use asset. The right of use asset. Asset. And number two, he is also supposed to recognize something called the risk liability. The risk liability. So meaning that if you lease an asset or if a company leases an asset, that company is expected to determine and recognize two items: the right of use asset and the risk liability. The right of use asset and the risk what? Liability. So in this case, we're going to look on how do we determine each of these two items, how do we determine the right of use asset, and basically how do we determine the risk liability. But even before you look on how we determine those two items, the risk liability and the right of use asset, there are two exemptions as far as this is concerned. So meaning, if, for example, you have been given the right to use an asset, we are saying recognize these two items, the right of use asset and the risk liability. But there are two exemptions. Or under those exemptions, it basically means that having risked the asset, you don't have to recognize the right of use asset, you don't have to recognize the risk liability in your books of accounts. So which are those two circumstances? Or basically, which are those two instances? So we can just refer to them as exemptions. Or exceptions, that is, exceptions. So exceptions basically have said that those circumstances whereby the lessee is not supposed to recognize the right to use asset and the risk liability. Number one is in case of a short-term risk. In case of a short-term risk. In case of a short-term risk. So remember, you have said a short-term risk is basically a risk whose risk term does not exceed 1 year. If you lease an asset or a company leases an asset for a period which is less than 1 year, that company is not required to recognize the right of use asset and there is what? Liability. So what that company is required to recognize in its books of account or to account for in its books of account is the amount which was paid as the lease rentals. The amount which was paid as the lease rentals, and this one should be recognized as an expense. So if you lease an asset basically for 1 month and you paid 20,000, do you need to compute the right of use asset and the risk liability? Automatically, no. We are saying the amount which you paid as a result of having leased that asset for that 1 month or for those 2 months, recognize that as an expense in your books of account. Number two is is in case of an asset of low value, an asset of low value, in case of an asset of low value. So what does that mean? It basically means that if, for example, you list an asset which is regarded to be of low value, you don't have to recognize the right of use asset and there is liability. Now, this standard IFRS 16 does not specify what is an asset, or basically does not specify the value, or basically does not specify the value of this particular asset, which is basically regarded to be an asset of low value, but it has given examples. So a good example of an asset which is deemed to be of low value is an old car. An old car. We also have something like a personal laptop, or maybe a personal computer, a personal what? Computer. So if you use any of these particular assets, an old car, a personal computer, then in this case, we are saying you don't have to recognize the right of use asset, and also there is what? Liability. So the amount you are paying as there is rentals, just recognize that as what? Just recognize that as what? As an expense in the statement. Then we can come back to this and look on how do we determine these two values. There is liability and the right of use asset. I want us to start by looking on how we compute the risk liability. And in this case, Morimo assumed here that you have done something to do with time value of money. I think this is the topic you started in FM, if I'm not wrong, the topic of time value of money. Time value of money, because there is a small concept you are going to apply here regarding discounting, how to determine the present what value, though I'll be able to show you how to do the same if you have not maybe covered that fully in FM, but I know you have started something to do this. So how do we determine the risk liability, abbreviated as LL? This one is computed as the present value of the minimum risk rentals, not paid at the inception date of the risk, not paid at inception date of the risk, not paid at the inception date of the risk. The minimum risk rentals, present value of the minimum risk rentals, which was not paid at the inception date of the risk. What does that mean? Let's assume that you have leased an asset, for example, for 4 years, year 1, year 2, year 3, and also year 4, and you have agreed with the owner of the asset that at the start of each year, you'll be paying maybe 1 million. So mean that at the start of year one basically this one, the start of year 1 is regarded to be times 0. So at the start of year 1, you pay 1 million. At the start of year 2, you pay 1 million. At the start of year 3, you pay 1 million. At the start of year 4, you pay 1 million. So this is how you're going to pay the rent. You're going to pay the lease rentals. Now we are saying to compute the lease liability here, we are saying that this one is equal to the present value. Basically, present value, from what you have covered in financial management, this basically involves discounting, getting the present value of future cash flows. Because you can see at the start of the risk, or on this date, these are future cash flows. We need to get their present value. So to determine this risk liability, we are saying we get the present value of the minimum risk rentals. Minimum risk rentals is basically the amount you are paying as a result of having risked an asset. So if you have risked an asset, you have agreed with the owner of the asset that you'll be paying 1 million at the start of each year. So this amount you are paying are the minimum risk rental. So this one is equal to the present value. The risk liability is equal to the present value of the minimum risk rentals not paid at the inception date. The inception date is the date when the risk commenced. So the amount which is not paid at the inception date is this one, and this one, because this one was paid at the inception date. This was paid at the inception date. So we compute the risk liability using the minimum risk rentals not paid at the inception date. Not paid at the inception date. It basically means that the risk liability will be equal to 1 million and then we need to discount this. So when discounting this, these are annuities. These are annuities. Maybe you have covered something to do with that in FM. So we take these annuities, 1 million, and then we multiply that with something called the present value interest factor of annuity. And always, whenever you are discounting, you'll be given a certain interest. You'll be given a certain interest, which is known as the interest rate implicit in the risk. In this question, for instance, the examiner will give you something called the interest rate implicit in the risk, interest rate implicit in the risk, or he can give you something called the receipt borrowing interest rate. Borrowing interest rate. For example, in this case, you can be given the receipt borrowing interest rate as 10%. That is the rate now which you use for the purpose of discounting. For the purpose of discounting, you use that particular rate which you are given there. The rate which you are given there. The rate which you are given, which you are given there, and which is known as the interest rate implicit in the risk, or the receipt borrowing interest rate. The receipt borrowing interest rate. Yes, so you take the 1 million, this 1 million, you multiply that with the present value interest factor, assuming you're given the rate as 10%, then you count these are how many periods. This is 1, 2, 3, because we are discounting this, and this. So our period are 3. So our end here will be 3. So there is a formula which we use in computing this. This is something I know you have covered in FM. This is a formula 1 minus 1 plus R raised to power negative n, and then we divide that with R. For example, in our case, our R here is 10%. Our R here is 10%, and then our N will be what? Our N will be 3. Our N will be what? Will be 3. Will be 3. Will be what? Will be 3. Will be 3. So our R 10%, our N will be what? Will be 3, because you have said we are discounting this amount paid for 3 years. Paid for what? For 3 years. Paid for 3 years. So that's basically how we compute the risk liability. So Zipper were saying we can't see the formula. You are writing down there. Zipper, my entire board, I can be able to see my entire board. So if you can't be able to see some part of the board, can you hold, if you're using your phone, just hold it like this, or even like this, you double tap. Should be able to see the entire board. Zipper. So work on that, because I can be able to see everything here. So therefore, once we have been able to determine this particular liability, basically this represents now the amount of money which the lessee should pay over the risk term. And actually, this particular liability, then this one should be amortized. So what do you mean by to amortize a liability? To amortize a liability, or even to amortize an asset, this is the process of gradual writing off. A liability. So this particular liability which has been computed at the inception date, then it should be amortized. It should be gradually written off such that at the end of the risk term here, this liability should be 0. Should be what? Should be 0. So that's basically how we determine the risk liability. And in this case, I've said that particular risk liability should then be what? Should then be amortized, should then be gradually written off. Then from there, we have the other item, which should be computed and recognized by the lessee, and that is something called the right of use asset. The right of use asset. Remember, in this case, what you have said, that once you lease an asset, first of all, you have an obligation to pay the lease rentals. Number 2, you will be enjoying all the economic benefits associated with that asset. So therefore, other than recognizing this lease liability, which we have said represents the amount of money you're going to pay over the lease term, you should also recognize the right of use asset. This basically is an asset. Why are you recognizing an asset in your books of account, though you are not the owner of this asset? So there is a certain accounting concept which is known as the substance over form concept. This is something you must have covered in financial accounting. Substance over form concept. Over form concept. Basically, this is a concept or a principle, an accounting principle, which states that if, for example, you are deriving some economic benefit from an asset, you are deriving some economic benefits from an asset, though you are not the legal owner of that asset, you have to recognize that asset in your books of account. You recognize that asset in your books of account, though you are not the owner. So that's why there is need to recognize an asset in his books of account known as what? The right of use asset. Now, how do we compute the value for this right of use asset? We take the risk liability. The risk liability at the inception date. The risk liability at the inception date. And basically, this risk liability at the inception date, this is the one which we compute by getting the present value of the minimum risk rentals not paid at the inception date. That is what we take there. The risk liability at the inception date. To this, we add the payment made at the inception date, payment made at the inception date, at the inception date. So the payment made at the inception date, for example, here is this amount. This amount, 1 million, it was paid at the inception date. It was paid at the inception date. Is a payment made at the inception date. To this, we also add any initial direct cost. Any initial direct cost. Any initial direct cost, e.g., the legal what? E.g., the legal fee. E.g., the legal fee. So what do you mean by a legal fee? Generally, if, for example, you are leasing an asset, you must be given something called a lease contract. So once you have agreed on the terms of the lease, so definitely that lease agreement has to be drafted by a lawyer. The lawyer will charge you some fee for drafting the lease agreement. So the amount you are charged by the lawyer for drafting that lease agreement is basically a legal fee and should also be part of that asset. So therefore, we add those three values: the lease liability at the inception date, the payment made at the inception date, any other cost which was incurred at the date the lease was commencing, and associated with the lease, e.g., the legal fee. And whatever you get here is called the right of use asset. Now, this particular right of use asset, because it's an asset, this one has to be depreciated. This right of use asset is what? Is depreciated. And this depreciation is computed on straight-line basis. And we say that the depreciation on right of use asset, depreciation on right of use asset is computed on a straight-line basis, at the shorter of two periods, on straight-line basis at the shorter of two periods. I'll be able to explain further what you mean by that. Shorter of two periods. So here we consider two periods. There is liability, not the risk liability, sorry, but there is term. There is term. The risk term basically is the period of the risk. So if you have leased an asset for 10 years, for 5 years, for 3 years, we refer to that as the lease term. That lease is for a term of 10 years, a term of 2 years, a term of 3 years. Sasa, yes. So we take the shorter of the lease term or Roman 2, the economic life of the asset. Economic life of the asset. Economic life of the asset. or in other terms, the remaining economic life of the asset. What that means is that you can be told that the lessee had leased an asset for like 5 years, So that is the lease term. But then you are told that the remaining economic life of that asset, the remaining useful life of that asset, maybe are 8 years. So for you to be able to compute the depreciation per annum, you take the period which is shorter. Out of these two periods, the lease term and the remaining economic life of the asset, take the period which is shorter. The period which is shorter, of which our period which is shorter is what? Is the 5 years. So meaning to compute the depreciation per annum, of this right of use asset, you will take this particular value here, assuming that is A, capital A, and then divide that with the shorter of these two periods. Assuming the shorter of these two periods is this one X. So you divide that with what? With X. So you have taken that value, which is the right of use asset, and then you have divided that with the shorter of these two periods, assuming this is X. So this now will give us the depreciation per annum. So therefore, those are the two items which the lessee has to recognize in his books of account. The lease liability, which you have said is equal to the present value of the minimum lease rentals not paid at the inception date. And we have said that that lease liability, once computed, it has to be amortized. It has to be gradually written off over the lease term, such that when the lease is coming to an end, that lease liability should be 0. Then number 2, the other item which the lessee should recognize is something called the right of use asset. The right of use asset is computed basically by adding those 3 values. And then in this case, we are saying that this right of use asset should be depreciated at the shorter of these 2 periods. The lease term, the remaining economic life of the asset, and then once you have taken the period which is shorter to compute the depreciation, take the value which you had there as the right of use asset, divide that with the shorter of the 2 periods. So those are basically the 2 items which should be recognized, or which should be computed and recognized by the lessee in his books of account. So with that, I want us to look on an illustration. From the past papers. So let's go to the past papers. And we look on a question on this. So, and I hope you're together up to that point. Are we together up to that point? Yes or no? Are we together up to that point? Are we together up to that point? I'm told yes by Helen. Are we together up to that point? Okay, so if we are, I want us to do a question. I think we have a question for August 2022. That is a question I want us to start with, August of 2022. August of 2022. And this was a question number what? This is question number 4A. Question number 4A. Question number 4A. So once you get the question, just confirm. Just confirm that you have the question with you. August of 2022. Question number 4A. Yes, or I think we can do this. Can we just take a short break? We take a short break and then we come back, we look on this question. Is that the case? Yes. So let's just take a short break, because once we start, I don't think we will get some time to break. So we take a short break of 10 minutes. You take a cup of water, then we come back, we look on that question. Make sure as we come back, you have that question with you. August 2022, question number 4A. So see you after that short break of 10 minutes, 10 minutes break. Yes, on 1st of January 2019, Breakwood Limited entered into a contract to lease an item of plant and equipment from a supplier for 3 years period. The terms of the lease were that Breakwood Limited was to pay shillings 500,000 each year, with the payment commencing on 31st of December 2019. Initial direct costs incurred on the lease amounted to shillings 30,000 and were paid for by Breakwood Limited. The plant and equipment had a remaining economic useful life of 5 years at the inception date of the lease. The lease contract did not contain any purchase option for the lease, and then you're told Breakwood Limited can borrow at the rate of 10%. So what are we required to do here? We're required to analyze the accounting treatment of the above lease transaction from the inception and for 3 years period of the lease. And the months allocated, then you can see they are 10 months. 10 months. Now, what you are told, and maybe going back to paragraph 1, is that 1st January 2019, Breakwood Limited entered into a contract to lease an item of equipment, plant and equipment, from the supplier for 3 years period. Now, in this case, who can tell us? Here we are given two parties. We are given two parties. We have the company which is called Breakwood Limited. Breakwood Limited, which you are told leased an asset from a supplier, leased an asset from a supplier. Now, the first thing you need even to do, even before you proceed to analyze how this transaction will be accounted for, is who is Breakwood Limited, who is the supplier. Remember, you have said in a lease, we have two parties. We have the owner of the asset, who is called the lessor, and we have the lessee. Now, out of these two parties, who owns this asset? Out of these two parties, Breakwood Limited and the supplier, who own the asset? Who owns the asset? I'm told by 𝐿𝐼𝐼𝐻, the owner of the asset is the supplier. And please, let's get used to participating in class. I'm not getting answers, please. Let's get used to participating in class. Otherwise, if you don't participate, Mwalimu will not be able to know whether we are together or not. Please participate in class. Type your answer in the chat box there. I'll be able to see the answer. I'll be able to see your answer. I've not seen any answer from Lucia. I've not seen any answer from Nur. I've not seen any answer from Zipporah. Please, let's participate in class so that we make the class a little bit lively. So I've not seen any answer from who? From Golden, from Alan, from Azera. Yes, can I get your answers here? Can I get your answers? Who, out of these two parties, Breakwood Limited and the supplier, who own this asset? Who is the owner of this asset? That's the first thing we need to know. Who is the owner of the asset? Yes, the owner of the asset is basically the supplier. So if the supplier is the owner, it basically means that the supplier here is the lessor, whereas now this party is the lessee. So having identified that, then we need to check what the examiner is requiring. So the examiner, if you go back to the requirement, we are required to analyze the accounting treatment of the above lease transactions at the inception and for 3 years period of the lease contract. So automatically here, we are required to analyze how this particular lease will be accounted for by this company, which leases the asset. So in other terms, we're required to analyze how this will be accounted for by the lessee. Remember, from our previous discussion, we have said, if you lease an asset and you are therefore the lessee, on the date the lease commences, you should recognize two items. One, the lease liability, and number two, something called the right of use asset. So what we need to do here is basically we determine those two items, the lease liability and the right of use asset. Always, we start by computing the lease liability. That is the first thing we are going to compute, and we compute this at the inception date. The inception date is the date when the lease commenced. If you go back to the question here, this lease commenced on 1st January 2019. The lease commenced on 1st January 2019. So what we need to do here is basically we determine the lease liability on that date. So How do we determine this risk liability? We have said that this one is equal to the present value of the minimum risk rentals, present value of the minimum risk rentals, present value of the minimum risk rentals not paid at the inception date. Not paid at the inception date. Not paid at the inception date. Now, for us to be able to determine this, for us to be able to compute this risk liability at the inception date, we need to go back to the information which are given here. Let's go back to the information which are given in our question. And actually, we are told that this risk, if you check on the first paragraph, the first sentence, we are told on 1st January 2019, Breakwood Limited entered into a contract to lease an item of plant and equipment for from a supplier for 3 years period. So meaning that this company, Breakwood Limited, leased the asset for how many years? For 3 years. Year 1, year 2, year what? Year 3. So having that, we need also to identify how much amount of risk rentals is payable. So in sentence number 2, still in paragraph 1, you're told the terms of the lease were that Breakwood Limited was to pay shillings 500,000 each year with the payment commencing on 31st of December 2019. So the amount of minimum risk rentals to be paid, we are told is 500,000, and we are told that the first payment will commence on 31st of December 2019. Remember, the lease commenced on which date? On this date. So meaning the start of year 1 is basically 1st of January 2019. So mean that the first installment of the first minimum risk rentals will be paid at the end of year 1 here. Will be paid at the end of year 1. So the amount to be paid there will be 500,000. Automatically, the other one will be paid at the end of year 2. Automatically, the other one will be paid at the end of year what? Year 3. That is how the minimum risk rentals will be paid at the end of year 1, at the end of year 2, at the end of year 3. Having such, then we can proceed and we determine this. The risk liability. We are saying this one will be equal to the present value of these minimum risk rentals, which was not paid at the inception date. So this particular amount, this and this, are the minimum risk rentals which were not paid at the inception date. This is the inception date. Do we have any amount which was paid there? No. So therefore, we take 500,000 and take into account this is an annuity. How do we discount an annuity? This, I don't know whether you have fully covered this in FM. To discount an annuity, we take the annuity. Annuity basically is a series of payments, or a series of cash flows like this one. We multiply that with the present value, interest factor of annuity. How do we compute this one? We use this formula. We take 1 minus 1 plus R, 1 plus R raised to power negative n. We divide all that with R. That is how we compute this one. And basically our R here in this question, I think the rate will be 10%. There is somewhere we're given that rate. And then our N are the number of periods. We are discounting this amount. So we have how many periods? 1, 2, 3. Our N here will be 3. So therefore, we take this multiplied by the present value interest factor of annuity. At which rate? If you go back to the question, I think in the last paragraph of this question, we are told Breakwood Limited can borrow at the rate of 10%. I've said when discounting, you will always be given a rate. So there are two names, that rate can be given two names. One, you can be given something called the interest rate implicit in the list. Is that the name used here? No. Number 2, you can also be given something called the receipt borrowing interest rate. That is what you're given here, being 10%. So the present value interest factor at the rate of 10%, and then for 3 years. Our N here will be 3. For 3 what? For 3 years. So having that, and I've said this kind of concept you'll be able to understand very, very well in FM, in financial management. So we take 500,000. Then how do we compute this? We compute this using this formula. using this formula. So we multiply that with the present value interest factor, and we use that formula, which is 1 minus 1 plus R. So 1 plus R. Our R is 10%. 10% is the same as 0.1. So which will give us 1.1. So this one will be 1.1 raised to power negative n. Our n is 3. So we raise that to negative 3. And then we divide that with R, which is 0.1. Whatever you get here is called what? Is called the risk rentals. Sorry, not the risk rentals, the risk liability at the inception date. So work out that figure and give me the final answer. So first of all, you should compute this one. So what do we have here? We have 1.1. We raise that to negative 3. We deduct that from 1. Divided that with 0.1 times 500,000 times 500,000. So I'm getting a figure of 1243, 426. 426. So confirm whether you're getting that value here. 1,243,426. 426. Is that what you're getting? That is the figure I'm getting from ZP. So are the rest getting the same? Null, are you getting the same? Lucia, are you getting the same? Ajara, are you getting the same? Helen, are you getting the same? So please confirm what you're getting here. Is that what you're getting? Yes, so that is already confirmed by Lucia. So, and also Helen. So we work with that. So that is now the risk liability. And actually this risk liability, this is the amount of the risk liability at the start of year 1. Now, basically what I've said, that this risk liability represents what Breakwood Limited will pay in the next 3 years. It represents the present value of what this company will pay for the next 3 years. And therefore, what I've said is that this particular risk liability has to be amortized. What do we mean by amortizing this? It basically means that we have to write off this amount for the next 3 years, such that at the end of year 3, the risk liability should be 0, just like how we amortize a loan. And that is a concept you'll be able to discuss. I don't know whether you have done that in FM, but you'll be able to prepare something known as a loan amortization schedule. If you take a loan of 2 million, you agree with the bank that that loan has to be paid back in the next 3 years, you must prepare something known as a loan amortization schedule to gradually write off that loan such that at the end of year 3, the loan balance should be 0. The same case, this amount you have computed here represents what Breakwood Limited will pay for the next 3 years. So what do we need to do? We need to amortize it. We need to gradually write it off such that at the end of year 3, the risk liability will be 0. How do we amortize this? We amortize this by preparing something called the risk amortization schedule. So therefore, that is what I want us we prepare here. Even before we proceed to compute the right of use asset, we prepare the risk amortization schedule. The risk amortization schedule. The risk amortization schedule. So which columns do we have in this amortization schedule? Basically, we have a number of columns. We have a number of columns in our amortization schedule. So the first column will be for the years. Basically, we're going to have 3 years. Remember, the first year started on 1st January 2019. It will end on 31st of December 2019. The other year will end 31st of December 2020. The other year will end 31st of December 2021. So we have 3 years. The next column here will be for the risk liability. Write that in full for your revision purpose. The risk liability balance brought down. The risk liability balance brought down. The risk liability at the start of each year. The next column here will be, depend with when the minimum risk rentals is paid. The next column be paired with when the minimum risk rentals is paid. So if the minimum risk rentals is paid at the end of each year, like in our case, this minimum risk rentals is paid at the end of each year. The next column here will be for the interest, expense, which is computed still using this particular rate here of 10%. But if the minimum risk rentals are payable at the start of the year, and that is, we're going to do a question on that in our next class. The next column here should be for the installment. So, but in this case, the next column here should be for the interest, followed by another column here for what? For the let's just refer to this particular amount as cash paid. And the last column here would be for the risk liability at the end of the year. The risk liability balance carried down, balance carried down, balance carried down, balance carried down. Yes, so I want us now we prepare this one together. I hope you already have that. You already have those columns with you. Those columns with you. So let's start with the first year here. So we always start with the risk liability at the start of year one. The risk liability at the start of year one is what you have computed here, which is 12, 43, 426, 426. So we compute the interest. The interest will be 10% of this, 10% of the opening balance. 10% is 124, 343 to the nearest whole number. To the nearest whole number, 10%. Can you confirm whether that is what you're getting? 10% of 1243 to 46 to 46. Is that what you're getting as 10%? As 10%, yes. So then from there, we proceed. We have the cash paid. So the cash paid at the start, at the end of year one is basically the amount which was paid by the owner of this asset. Sorry, by Breakwood Limited. Breakwood Limited has leased the asset. So at the end of year one, Breakwood Limited paid an amount of how much? This is the amount which was paid at the end of year one, 500,000. 500,000. Then what we need to do is basically to compute the risk liability at the end of the year. Remember, I've said this particular amount which we have here is just like a loan. Once you have leased an asset for 3 years, you have an obligation to pay for that asset for the next 3 years. This is just like a loan you have taken from the bank. At the end of year 3, that loan must be fully paid. So the same case. So this is like a loan balance at the start. This is the interest which was charged during that year, and our company paid this amount. How do we compute this one? Like, how do we compute the loan balance at the end of the year? Very simple. If we take your loan balance at the start, we add the interest which you are charged during that year, and then we deduct the amount which you paid. That will give us your loan balance at the end of the end of the year. So give me this one. The risk liability at the end, which is equal to the risk liability at the start plus the interest charge minus whatever was paid, minus the amount which was paid during that year, minus the cash paid during that year. Minus the cash paid during that year. Minus the cash paid during that year. Yes, what are you getting? What are you getting? What are you getting? 867. 867. 769. So that now will be the opening balance there. The loan balance at the end of year one will be the loan balance at the start of year two. That will be the opening balance here. And then we compute the interest, which will be 10% of this. So which is 86,777. 777 to the nearest whole number. How much amount was paid at the end of year one? 500,000. So give me this one. The risk liability at the end of year two. The risk liability at the end of year two. The risk liability at the end of year two. Risk liability at the end of year two. lease liability at the end of year 2. So I'm given a figure of 45, 45, 45, 45, 46. 45, 45, 46. So that will be the opening balance here. 45, 45, 46. So we compute the interest being 10% of that, which will be 45, 45, 5. Yes, 45,455. So how much amount was paid? 500,000. So basically, even without computing this, there is liability at the end of year 3. That one should be 0. That one should be 0 because the objective of preparing this amortization schedule was to write off this, to gradually write off. Are you getting 0? So you may get a figure which is not exactly 0, but you should get a figure which is insignificant. What are you getting, sir? Like you should be getting like 1. Are you getting 1? This plus this minus 500. Yes, 1. But essentially that should be 0. The reason why you're getting 1 is because of rounding off. So that is basically how we determine what? We determine the risk liability. Then next, we need to proceed and we determine the right of use asset. 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 So the right of use asset, this one we have said, is computed basically by adding 3 values. And also remember this right of use asset, we are computing this at the inception date of the lease. The lease commenced on 1st of January 2019. That is the date we are computing the right of use asset. How do we compute this one? We compute this by adding the 3 values. The lease liability at the inception date. The inception date is 1st January 2019. This is the date when the lease commenced. So how much is the lease liability on this date? The amount which we computed here, 12, 43, 426. That is the lease liability at the inception date. Now, having that, then we need to proceed. And we add something else. So to this we add what? To this we add payment. Payment made at the inception date. Payment made at the inception date. So basically, this in our question here, we don't have any payment which was made here. Ordinarily, this payment made at the inception date, this is usually the amount of the minimum lease rentals which was paid at the date when the lease commenced. In other terms, you will only have this payment made at the inception date, whereby the minimum lease rentals are payable at the start of the year. If, for example, this 500 was paid at the start of year 1, this one at the start of year 2, and this one at the start of year 3, then the amount paid at the inception date would be this amount which was paid at the start of year 1. Yes, but I've said the other question we are going to do is whereby this minimum lease rentals is payable at the start of the year, because these minimum lease rentals for this question, they are payable in arrears. They are payable in what? In arrears. This is also another concept we'll discuss in FM. In case of annuities, because these are annuities, we have annuity due, and also we have ordinary annuities. Those annuities which are payable or maybe cash flows received at the start of the year, and those cash flows which are received at the end of the in terms of how we discount them, there is a difference. That is what? A difference. So therefore, these minimum lease rentals are payable in arrears at the end of each year. We are going to do another question whereby a company leases an asset, but it is paying the minimum lease rentals at the start in advance. Yes, so that you see what is the difference in terms of how we determine the lease liability and the right of use asset. So in this case, I'm saying we don't have any payment made at the inception date. And then to this, we have said we proceed, we add initial direct cost associated with the lease. And this one include the legal fee, or basically the legal cost. If you go back to our question here, there is somewhere we are told there was a legal cost which was incurred. That is given within paragraph 2, we are told the initial direct costs associated with this amounted to 30,000 and were paid by Breakwood. So we have initial direct cost of how much? Of 30,000. So what we need to do here, basically we add this. We add that, and that now will give us the right of use asset, the right of use asset. So what is the right of use asset here? Yes, I'm given a figure of 12,73,426. Now this right of use asset we have said is an asset to Breakwood. Breakwood Limited in the balance sheet, in the statement of financial position, we recognize this as an asset. But we have said because it's an asset, it has to be depreciated. How do we compute the depreciation per annum? We have said to compute the depreciation per annum, we first of all need to take a total of these two periods. There is term. This is for how many years? And the remaining economic life. The remaining economic life of the asset. If you can be able to recall, we know that the lease is for 3 years, year 1, year 2, year 3. The lease is for 3 years. That is something we already have. What about the remaining economic life of the asset? The remaining economic life. This one is also given. In paragraph 2, sentence number 2, we are told the plant and equipment had a remaining economic useful life of 5 years at the inception date. So the remaining economic life of the asset, how many years? 5 years. The lease term, 3 years. So we take the period which is shorter. So the period which is shorter in our case will be how many years? The period which is shorter will be how many years? Will be 3 years. Will be 3 years. So to compute the depreciation per annum, the depreciation per annum of this right of use asset, depreciation per annum of right of use asset, we take this amount here, 1273,426. We divide that with 3 years. Divide that with 3. That will give us the depreciation per annum, the period which is shorter, 3 years. So how much is the depreciation per annum here? How much is the depreciation per annum? The depreciation per annum is shillings 475. And basically that is what? Per annum. That is per annum. Now, that's how we depreciate. We determine the depreciation per annum. Now, have we answered the question? That is the question. Have we answered? Have we been able to provide what the examiner was requiring? Now, if you go back to the question, we are required to analyze the accounting treatment of the above risk transaction from the inception, from the date it commenced, and for 3 years. Now, for you to be able to do what? To analyze how this was supposed to be accounted for, you need to prepare financial statement extract for year 1, year 2, year 3. And the financial statement extract include the income statement, include the statement of financial position. You show what was supposed to be recognized, for example, in the income statement, what was supposed to be recognized in the statement of financial position. So therefore, for us to be able now to finally answer our question, we need to prepare the financial statement extract. So that's why you can see that question. The marks allocated here were 10 marks because you can see the kind of work which is involved here. So we start by preparing the income statement. And remember, this income statement is just an extract. What do you mean by an extract? Who can tell us what is an extract? An extract is what? What do you mean by an extract? Extract of, yes, this is part of the income statement, because we know for us to prepare the income statement, we must be having sales, the cost of sales, expenses, and so on. In this question, there is no way we're given the sales of this company. There is no way we're given the cost of sales. So we are just preparing this income statement. This is part of the income statement, and we want to show what this company was supposed to recognize here as either an income or either what as an expense. And actually, this one we prepared it for 3 years. These 3 years. The first year ended 31st December 2019. the other year 31st of December 2020, and the other year 31st of December 2021. Now, this company was supposed to recognize 2 items of expenses. Which are those 2 items? The first one is this one. The depreciation for the right of use asset should be recognized in the income statement as an expense. And number 2, this interest. This interest should also be recognized here as what? As an expense. Should be recognized here as an expense. So under the expenses, our company was supposed to recognize 2 items of expenses. One of it is depreciation on right of use asset. You can write that in full. Depreciation on right of use asset. And it is this amount, 475 per annum for year 1, year 2, year 3. That will not change in the next 3 years. So 424, 475, 424, 475, 424, 475. That is depreciation per annum. It will not change. Then still our company was supposed to recognize the interest expense. So this interest expense, in other terms, we refer to this as finance cost. Finance cost. So the finance cost of the interest expense for the year 1 is this amount here. 124, 343. So for year 2 is this one. 86, 777. And for year 3 is this one, which is 45, 455. 455. That is what our company here was supposed to recognize, as what? Or was supposed to recognize in the income statement. So if you are together up to that point, I want us to wind up by preparing now the statement of financial position extract. Is there any question up to that point? Is there any question up to that point? Do we have any question up to that point? Any question up to that point? Any question up to that point? I hope not. I can't see any question. I hope you have understood what you have done up to that point. Then finally, we prepare something called the statement of a financial position. Statement of a financial position. Still, this is an extract. An extract basically is part of the statement of financial position. Statement of finance is part of the statement of financial position. Now, in this case, our company will recognize 2 items. Here, 2 items to be recognized. One is this one, right of use asset. Right of use asset, I've said this company will recognize this as an asset. Number 2, our company will recognize something called the risk liability. This liability is a liability. So when preparing a statement of financial position, we first of all record assets, we record capital or equity, and then finally we record what? Liability. So we will start by doing what? We will start by recording assets. So basically under assets, specifically under the non-current assets, so our company was supposed to recognize something called the right of use asset. The right of use asset. And actually, we will show the amount which was supposed to be recognized as the right of use asset for 3 years. The first year, which ended 31st of December 2019, 31st of December 2020, 31st of December 2021. So the cash to be paid just reduces the liability. That one is not recognized here as either or is not supposed to be recognized there as what? As an expense. So the right of use asset, how do we determine the amount to be included here, to be recorded here? So this one should be recognized here at the net book value. We recognize this one here at the net book value. How do we compute the net book value of an asset? We take the cost minus the accumulated depreciation. That is how we compute the net book value of an asset. For example, in the first year, to compute the net book value of this asset, we will take the cost. This is like the cost of the right of use asset. The right of use asset has this value. at the start of year one. So we less the depreciation for year one. The depreciation for year one would be this one. Now, once we go to year two, we take the cost this one minus accumulated depreciation for how many years? For 2 years. Depreciation for year one is this one. Depreciation for year two is the same. So at the end of year two, we less depreciation for 2 years. In year three, we take the cost this one minus depreciation of how many years? 3. Year one, year two, and year three, which is this one times 3. Sasa? Yes. So can you give me the net book value at the end of year one? The net book value at the end of year one would be this one minus just depreciation for 1 year. Minus depreciation for 1 year. That will give us what? That will give us what? Let's hurry up because of time. That will give us what? Yes, I'm given 849, 951. And then year two, we take these ones minus depreciation for 2 years. Alternatively, you can just take this one because this is the net book value at the end of year two, then you less depreciation for year two. You take this minus depreciation for year two, which will give us what? Which will give us 424, 476. And then at the end of year three, you take this minus this, basically, which will give us 0 because our asset at the end of year three is fully depreciated. Is fully depreciated. We have depreciated our asset for the next what? 3 years. For the next 3 years. And then from there, we have said that this lease liability which we have here, we recognize it here as a liability. But now, when recording this particular, when recognizing the lease liability here, we split it into 2 components. We have a lease liability which is payable within 1 year, and that one will be recognized here as a current liability because basically what you need to record is that we have 2 categories of liabilities. We have non-current liability. This is something or liability payable for a period exceeding 1 year. A liability payable for a period exceeding 1 year. And then we have the current liability, which is a liability or amount payable for a period of less than 1 year. So this lease liability, we split it into 2, into non-current and current. I will be able to show, or I show you how to do that split. We have a part of the lease liability will be recognized here as what? As the non-current liability. As non-current liability. And part of it, so basically under the non-current liabilities, we will have something called the lease liability. And still under the current liabilities, liabilities, we will equally have something called the lease what? The lease liability. The lease liability. So let me show you first of all how we determine this lease liability, which is supposed to be recognized as a current asset, which we recognize as a current asset. I hope you're together here because this one is a little bit tricky. You need to be very, very keen. You need to pay a lot of attention here for you to understand how we split this. Now, I've said a current liability is a liability payable within 1 year. Payable within 1 year. Sasa? Yes. So in terms of how we determine the amount to be recognized here as a current liability, we get the difference between these two because this is the lease liability at the end of year 1. At the end of year 2 is this. So basically, the decrease is the amount which has been paid within 1 year, So therefore, the amount to be recognized here as a current liability should be the difference between these two. Should be the difference between those two values, between those two liabilities. What are you getting here? What are you getting? What are you getting? What are you getting? What are you getting as the difference between these two values here? Is have been given 413, 223, 413, 223, 413, 223. That is now the amount we recognize here as a current liability. This is the amount which, at the end of year one, the amount to be paid within 1 year should be that it decreased. Because at the end of the second year, you can see this is the amount which the company will have paid, which is equal to the decrease. Which is equal to the decrease in what? In liability. We do the same here. We take the difference between these two values. And actually the difference, because this one is 0, the difference should be this one, which is 4, 45, 45, 45, 45, 46. So that is the amount which is payable within the next 1 year. That's why you can see this was the liability, the amount which are not being paid at the end of year 2, but at the end of year 3, it is 0. So this is what has been paid within the next 1 year. What about year 3 here? So you can see this 0, and basically in year 4 we don't have any this liability. So here we have 0. Here we have 0. So that is how we determine the amount to be recognized here as what? As a current liability. So what about the amount to be recognized as a non-current liability? The non-current liability basically is an amount which is payable for a period exceeding 1 year. For a period exceeding 1 year. So therefore, to determine the amount to be recognized here as a non-current liability, at the end of year 1, here, so that is the year which ended 31st December 2019, we take the risk liability at the end of year 2. And I hope you're paying a lot of attention here. You need to understand this. So at the end of year 1, the liability which is payable for a period exceeding 1 year is this one. So at the end of year 1, take the risk liability at the end of year 2, this one, which is 45, 45, 45, 46. Are we together? Then at the end of year 2 here, 2020, take the risk liability at the end of year 3. At the end of year 3 here. At the end of year 3 here. This one, which is basically what? 0. Which is 0. At the end of year 3, take the risk liability at the end of the following year. And actually, we know our risk is purely for how many years? Our risk is purely for 3 years. So we don't have any risk liability at the end of year 4. At the end of year 4. Have we understood what you have done here? Because this is one of the tricky area. Majority of the students don't understand. So I hope you have understood what you have done here. Noor, Zipporah, Lucia, Helen, Azra, have you understood what you have done here? This is one of the area. Majority of the students say is a little bit is tricky as far as accounting for leases by who? By the lessee is concerned. Aaron, Golden, Helen, Lucia, Zipporah, have you understood what you have done here? Yes, yes. Though if you have not clearly understood, we will be able to do another question. We will be able to do another question in our next class. We will be able to do another question in our next class, whereby we are going to, or the question we are going to do next is whereby the minimum risk rentals are payable at the start of the year. If you check this question, the minimum risk rentals were payable at the end. So, but we are going to do another question whereby the minimum risk rentals is payable at the start. So, what was to be marked in this question? This is what was to be marked. So, the amount which was supposed to be recognized in the income statement and what the company was supposed to recognize in what? In the statement of financial position. By doing that, you can see the marks allocated there were 10. What 10 marks? What 10 marks? What 10 marks? What 10 marks? So therefore, that's basically how the lessee account for the leases. And basically, I've said that once we meet in our next class, we're going to look on another illustration, still on accounting for the leases by the lessee, whereby the minimum lease rentals is payable at the start of the year. Sasa, yes, but for today, unless maybe there is a question, I want us to stop at that point. I don't know whether there is any question before we wind up.